Welcome back, everybody. I'm Forrest Riles,
I'm Ed Cox, and this is Magnolia on Money,
where we discuss everything financial from the economy to retirement.
Hey, everybody. Welcome to 2025. Things look a little bit different. Forrest and I have a new studio we're working out of, so we both can be in the show and give you both of our perspectives on what's going on in the market and the economy. So we're really looking forward to it. Hope you enjoy it.
Today, with the state of the market for 2025, first we're going to look back in 2024 to see what the market returned, and then some outlooks of where we think growth is going to come in 2025. And then finally, what our office is doing to be able to be proactive in 2025.
Okay, let's look at where we are today. So this is a look back at the S&P 500 over the last year in 2024, actually. So we highlighted some of the main things that happened. We had NVIDIA earnings that beat expectations early in the year. We had a rate cut hopes that grow after the soft job report numbers. And then we had our first interest rate cut since 2020. That was a big one that happened around October. Then we had Trump winning re-election, and we ended the year at a little over 23%. So awesome year in the market last year. We had a lot of things happen. And let's see how that stacks up against most years. So this goes back to 1995, the S&P 500. So last year you can see we were, in 2024, we were up 23%. Year before that, in 23, we were up 24%. Then 2022, as everybody remember, was a bad year in the market. We were down 19, and then you can see the years before that. But realistically, if you look at it, the last 6 years in the market have been really, really good. Take the 2022 out, but if you average it out, we've been really, doing really well in the market. So now let's look at what sectors our returns came from. So communication services, information technology, consumer discretionary, and financial led the market by far with our returns from those sectors, where materials, healthcare, real estate, energy really lag behind in those sectors. So once again, just a good look of where our returns came from a sector standpoint. And then what was really exciting to see, there were 57 new all-time highs in the market last year. And you look at that, you see 2023, there were no new all-time highs, but the market was up 24%. Why was that? Well, remember, we were recovering from 2022's negative ending in the market. So a lot of that growth was actually recovering. So we never got a new all-time high last year, but this year we had 57 new all-time highs in the market. Great numbers. Everything's doing good last year with the market. One last thing I wanted to talk about of kind of where we've been. So this graph shows that most years in the market are positive. So if you can see to the right of that dotted line, most years are positive. So you can see the years where we had 0 to 10% returns, 10 to 20, 20 to 30, and then 30 plus percent in the market. That represented 73% of the times or years in the market are positive years, with only 27 being negative. And what I really want to point out here is when we look at what people mostly are concerned about, they're really concerned about that 20 plus percent downturn in the market. A 5% downturn or 10% here and there. People are mostly concerned about that negative 20 or more. And so what we see by this is those 20% or more corrections only have happened 6% of the years. So very rare do we get that, but we do. We saw that in 22, but it is more on the rare side of things.
So now let's look at what is actually driving the markets themselves.
So the first thing we look at here are our speedometers. We normally show these about twice a year. We don't like to look at them on here, too often, but a couple of times a year we look at all of these indicators to see what is driving our current market. So on the positive side, if you look, the green on here is positive. The yellow is more of a neutral. So we feel like the next 6 to 9 months is kind of a neutral standing. And then red is, of course, we see some negative headwinds there. So if we look at the positive side, the labor market, unemployment is low. Also on the positive side, business outlook, companies are improving earnings, and especially with AI, they're cutting cost of production, cutting cost actually on labor. So that's a good thing. Now on the negative side, the equity market valuation, which we'll talk about a little bit later too, are a little bit on the high side. So if you look at the valuation of where stocks are today, they are on the high side, which is why we have a negative. And then, we're always praying for world peace because geopolitical events are one of the negative things we are dealing with now that puts pressure on markets.
So this slide is showing the makeup of the S&P 500. So if we look at this, we see where 10 companies are making up more than 35% of the market share out of the S&P 500. Let's look at the next slide to see how that may affect the returns on the overall market. So let's break it down even further and just take the top 7, which is often called the Magnificent 7. So the Magnificent 7 is really returning 48% in 2024, while the S&P's return was 23%. So if you take out the Magnificent 7, the S&P 500 would have only performed close to 10%. So we see where AI is really driving the market.
So a few reasons that the Magnificent 7 and AI companies are driving the markets are due to profit margins. So the top of that graph, you can see in the green, the Mag 7 profit margins are at 23.5%. And then you look at the rest of the S&P 500 there at the bottom at 9.3%. So yes, they are driving the markets, but that's because they have really, really high profit margins and they're making a ton of money. So as we know, profits equal increased stock value. So that's why we're seeing that. The other reason as to why the U.S. is really dominating on the AI side or the technology side, this is a good, and Forrest and I talked about this the other day. Look at where the U.S. ranks, and this is data centers. So it shows on the far left there, United States, 5,300 data centers versus the next country, Germany, in line only has 521. So if you take the next 10 countries, they do not even make up what the U.S. has in data centers. So we are leading the charge in AI. We own the space now. Don't care what anybody says in the market. The U.S. owns the AI space. And this is one of the big reasons we have so many data centers and we keep growing that across our country. So big reason why AI is taking off and why we're leading that charge is, and you can see it in the numbers of the data centers. So this slide here talks about our real domestic, our real GDP and where that comes from. And, Forrest and I talk a lot too about the growth we have seen. If you look at that graph on the side where it's like the bar chart there, you see the green, the consumption number. So you see how much of our growth, our GDP from last year came from consumption. So, consumption, what does that mean? Forrest, and you can talk about that, where's consumption coming from?
I mean, yeah, if we know one thing about Americans, it's that we are going to consume, we are going to spend money, right? So a lot of our spending that we do as Americans really drives the market itself. So if we look at growth, it was in large part due to Americans making and spending more. We finally got those cost of living adjustments due to high inflation here about a year or two ago. So about 68% of GDP is from consumptions that Americans go out and spend.
What do you think about 25?
I think we'll continue to spend.
Yeah, I think we'll still get the growth coming from consumption. So consumption, I think, leading into 25 will be a big deal. All right, so let's look at what may lie ahead. Okay, so we kind of led into that a little bit, but let's look at that. So in this slide, we're looking at what are the expectations of some of the top economists in the country think of where we may end the year of 2025. So if you look at this, and we do the math for you, the target suggests a roughly 10.5% gain in the benchmark over the next 12 months. So right in line with long-term averages. We'll see how the year shakes out, but that sounds pretty good to me. But let's wait just a second. How much do these economists really know? I went back. Let's look at what they thought of 2024, what it was going to be. So if we look back to 2024, look at JP Morgan. JP Morgan Global Equity Strategy Team projected that the S&P would finish 2024 at 4,200. That's at 4,200 on the S&P 500. A roughly 8% decline. That's a 30% spread between where the market ended up. So JP Morgan thought we were going to be down 8%. We ended up up 23%, 30% spread. So, everyone on this list, now this is, once again, this is what they predicted 2024 was going to look like. So everyone on this list were 13% or more under what the S&P actually performed. So take it with a grain of salt when you look at what the projections of these economists are, because I guarantee you this, they're not going out there touting what they predicted last year and what the market actually ended up. So markets are a little bit unpredictable. We don't know what interest rates are going to do moving through 2025, but we'll take it with a grain of salt as to the 10.5% they think it's going to grow. I hope they're right. All right, so let's look at some of our potential tailwinds that we have. We have the Trump tax cuts just came out. A lot of the tax cuts are trying to reduce or eliminate the tax on Social Security. So that's a big one. Hopefully we can get the Trump tax cuts to be extended or even improved upon. Deregulation, so looser regulation environment is expected to boost our economic growth and corporate earnings. Stock market optimism is a big one. The incoming administration is largely perceived to be pro-stock market. So it just, the thought of that really brings people to be more optimistic and purchase. So some of the tailwinds we do have trade tensions. We've seen that in recent weeks where tariffs are coming into play. That's going to be a big one. Tariffs are inflationary as well, or they can be if in place for long periods of time. Deficit concerns, as you cut tax cuts, that reduces the income that the federal government is bringing in. So we do also have deficit concerns. And then our labor market is tightening. So we'll look at how that pans out this year. But all in all, pretty good tailwinds. We should be set to do pretty well this year.
All right, next, let's look at what strategies are we employing at Magnolia Wealth. One of the strategies that we use, especially after a year like last year where the stock market did really well, is we need to rebalance your investments. That's something that we're going to look at in the first quarter of this year, is we need to make sure that your portfolio is back in balance.
Forrest, this is a good topic here because in a year like we had in 2024, where a large portion of our growth came from a small portion of the market, this is really important. And you and I have talked about that a good bit coming into this year as to we need to make sure the portfolios get back into balance. And we'll be looking at that, like you said, in the first quarter.
So another strategy, whenever we're rebalancing your accounts, is to make sure that we rebalance your 3 buckets. So most of our clients are probably familiar with this slide, or at least somewhat of it, is where you're taking your money from. That's your short-term bucket, right? So we need to make sure that you have enough to be able to pull your money from every month or however often you take money to be able to make sure that we are back in balance and we're not overextended maybe in long-term money.
Yeah, then you got, midterm, long-term. So as these buckets replenish themselves, as you come in for your reviews, of course, we're always looking at these buckets, but that's one of the strategies. We have to make sure that we are replenishing these, we're rebalancing, shuffling the deck, so to speak, so that long-term money stays long-term and short-term money stays short-term. All right, so the next slide shows the importance, like we said in the previous slide about the buckets, is long-term money being long-term. As you can see on the left hand of this graph, 1 year in the market has a lot of volatility. We have, 52% on the upside, 37% on the downside with stocks. There's a wide variety or a range of positive and negative periods in the market. As you move to 5 years, look how dramatically the negatives decrease. So at 5 years, we've almost done away with all of our negative downturns in a 5-year rolling average. And when you go to 10 years, even more. That's why we tell people we have to make sure our long-term money is long-term, because look at the difference in 1 year versus 10 year in the negative periods of the market that we can avoid by just being in the market for that long, for that period of time.
And I would say, looking at the last 2 years of the market that we've had, it's easy to get, overextended to say, well, the market's done really well.
Yeah, we kind of get sucked in.
I'm okay with leaving my money in that more risky account, but we've got to stick to the plan and let short-term money be short-term and long-term money be in a bucket where we don't need to touch that money for a very long time.
Yeah, great point.
All right, and then our last strategy is we want to look at strategies to be able to reduce taxes and take advantage of our low tax environment. Looking at this year, we think that taxes may stay pretty low for the next few years as far as we can see. But if we look across history, we see where we're in a very low tax environment. So we need to make sure that we're implementing strategies to be able to take care of our money in this low tax environment.
Yeah, I think we've been given, at least I can say maybe 4 years. If they can get tax law passed to reduce taxes, I don't think we need to be rocked to sleep. I think we need to say, look, let's take advantage of the opportunity we have. And you will hear us throughout all of the meetings you have with us, making sure that we're taking advantage of this gift that I think we're about to be given in tax reduction, so we can at least maybe for the next 4 to 5 years do more with tax planning than maybe in the future. So you will hear a lot about tax moving forward over the next 4 years. So that kind of wraps us up on 2025 State of the Market. We hope this helped with understanding where we've been, where we're going, kind of the strategies we have in place. But we look forward to this year. We look forward to seeing you guys, and there'll be more of these shows to come.
Yeah, we're really excited about this year. We've had a great last few years with the market. We hope that continues, but we also hope to be able to bring value to you guys and be able to see everyone come in this year and, help you the best we can.
As always, God bless. Y'all have a great week. We'll talk to you soon.